I think if anything right now, the thing we're probably most excited about is a recovery in Europe. If Europe continues with quantitative easing, which we think they will, a lot of Europe is earning potentially 50-60% below its previous peak. A lot of companies are well below their previous peak, significant amount of spare capacity. The stocks there are the cheapest in the world at the moment, with the most potential for earnings to recover. And so we know Europe pretty well because we've been working there for a long time and we're currently based there. And from that point of view, we find, particularly in mid-cap Europe, we find some really quite good ideas, particularly around rent-a-car companies like Europcar and Six Rent-A-Car, retirement homes, companies like Allpeer, around the healthcare sector. Fresenius looks very interesting to us. And so from that point of view, I think at least for the most runway for growth ahead of it, we quite like a lot of the stocks in Europe at the moment. Another one I'd mention is Kingspan, which we've owned for a long time, which is essentially an insulation company in Europe. It's very leveraged to a European recovery, but at the same time has that structural growth characteristic of increasing insulation penetration. So that's probably where our best ideas are at the moment. Well, hopefully it continues to weaken. I mean, that's the strategy. And we're lucky in the fact that we can manage the currency. So the stocks and the currencies are done independently. So we can invest in Europe on a hedge basis and so not benefit from the falling not suffer from the falling currency. But clearly the plan is to weaken the euro and increase competitiveness. They're basically following the same playbook from America and Japan. And provided they stick to it and they can hold the politics together, there's no reason why it shouldn't work the same way.